we go. 3, 2, 1. And on April's trade balance, pretty darn close to expectations. Of course, it's red ink, minus 50.8 billion. In the rearview mirror, slight revision, 51.9. If we look at non-farm productivity, first quarter final numbers, a nice jump here, about as expected, but 3.4, and that follows 3.6. These are pretty good numbers on productivity. Unit labor costs minus 1.6, a little bit larger, but that's not necessarily a bad thing. When productivity moves up, one would expect that. Initial jobless claims for the most recent week, a wash, a goose egg. Very unusual to see that, actually. It was originally released, if you all remember, at 215, and now it stands revised at 218, which is the current read as well. On continuing claims, a week in the rearview mirror, we move from 1.662 million to 1.682 million, so a slight increase there. Synthesizing all the data, nothing too wild or earth-shaking here. I don't see anything in the trade balance that's going to have any major inputs into altering our perceptions of GDP. We are hovering at 2.10 in a 10-year note yield, which is somewhat surprising on its own. The volatility in some of the short maturities has been just incredible the last few sessions, making the big curves steeper mostly and making the short curves more inverted mostly. And, of course, we're going to continue to monitor all that as negotiations with regard to U.S.-Mexico. Joe, missed being at the desk. Back to you.
I know. It was great to have you here, Rick. Stick around. Join us now. Michael Gapen, chief U.S. economist at Barclays, and CNBC senior markets commentator Mike Santelli, who I think we're going to see tomorrow for an extended amount of time. Let me start with you, Michael. Is a recession staring us in the face right now?
I don't think so right now. I think what we are looking at is something that feels more like the industrial recession of 2015 and 16, maybe localized to the goods sector. That's at least what the trade data is telling us. But the job market data overall says that things are still pretty.
What are these people that are talking about this? And there are a lot.
Sure.
What's the main data point that they're using it to judge? The yield curve?
No, I'd say 3 data points in April that bothered types like myself: the industrial production report and the durables report, and then the April trade balance. All 3 of those took our tracking estimates from equipment spending from kind of +5.
And you think that explains what happened in the 10-year?
No, I'm just saying in terms of it suggests there could be a lull in activity that you believe the Fed should respond to in a risk management mode, but it does not yet signal recession in the U.S.
Do you think there's nothing to fear but fear itself? Do you think that worried about Mexico, worries about China have already, maybe we haven't seen it in the actual numbers, but has it already caused people to pull in their horns in terms of investments and planning for hiring, things like that?
I can't prove it, but I think that is part of the narrative where there's just enough uncertainty about trade policy going back to a year ago that the average corporate says maybe we should just hold off on some of these projects. So it's not that you need the tariffs in place to have things slow. The threat of them in the extended environment of uncertainty just could cause things to slow. Historically, that's not a recession, right? 2015 and 2016, growth slowed down to about 0.5%, but consumption was okay, services employment was okay, and the economy accelerated back out.
Rick, did the not being able to find people for positions, did that explain the 27,000, the disappointing number on Wednesday? Or you think that the participation rate is a big pool of people that could still come back, don't you? Or how do you explain Wednesday's number?
I can't explain Wednesday's number, Joe. ADP, I've always looked at ADP, great organization, but I think they're trying to morph the number to be an early exact kind of replica of our Friday Bureau of Labor Statistics number. But I do separately totally believe in the fact that we do have a pool of workers we can draw back in. And I know that flies in the face of so many economic issues and analysts' interpretations. We're late cycle, employment isn't going to give you the picture, it's lagging. I get all that. And also the notion indication that the demographics are really going to take hold. I still believe that the uncounted will slowly come back into the workplace. And on a separate note, I know tariffs all the rage, and our guest is right. It's the threat of tariffs. But even in the service sector, ISM respondents, some of the information released yesterday, it certainly seemed as though the common denominator is that much of the service center activity wasn't seeing any effects of tariffs. They saw some higher input costs, but they also raised their costs, and their business was good. So, I mean, you can slice and dice it any way you want. There's always threats. I've never known us to come on Squawk Joe and say, okay, we have nothing to talk about because the world's at peace. We have a kumbaya business moment. There's always threats of something everywhere. You know, I don't necessarily want to discuss climate change, but, you know, business change, landscape change, that's part of everyday operations for these CEOs and CFOs.
Yeah, we always find uncertainty. I mean, that's the one thing we say again and again. Well, there just seems to be a lot of uncertainty right now. And I don't know, CEOs that aren't ready for uncertainty shouldn't even be, that's why you pay them $20 million a year. They ought to be able to have some uncertainty in their life, right?